Welcome and thank you for joining part 2 of SciFROT's webinar series, SPACs, what they are, why they are popular, and the issues they now face. All participants are in listen-only mode. You are encouraged to submit questions throughout the program using the Q&A section located on the right side of your WebEx window. We will do our best to get to everyone's questions. Any unanswered questions will be followed up by email after the webinar. For those interested in CLE credit, an attendance verification code will be read during the presentation. Please write this code down. It will not be repeated and is required for CLE credit. Copies of the webinar recording and presentation materials will be distributed to attendees in the days following the webinar. At this time, I'd like to turn the program over to Greg Markell. Greg, you may begin.
Thank you, Sadie. So it's my pleasure to introduce two of my really outstanding colleagues. First, let me talk a bit about my partner, Daphne Morduitz. Daphne is a terrific lawyer, has been practicing for almost 17 years at major law firms. Her practice focuses on securities litigation defense work, and she's developed a high degree of expertise in that area, among other areas. Daphne has been involved in many securities cases, including high-profile shareholder class action lawsuits, derivative suits, and enforcement actions. She has extensive experience representing public companies, special committees, and individual officers and directors of large publicly traded corporations. Daphne's been recognized and this is at a young age for a lawyer and for anybody, but particularly for a lawyer being recognized, as I'm about to describe. She's been recognized by the Legal 500 for securities litigation defense and financial services litigation, was listed in benchmark litigations under 40 hot list for 2016, and its future star list for 2020 and 2021. She regularly writes and speaks on securities litigation developments and issues. Next, and another truly outstanding lawyer, Matt Catalando. Matt represents companies, directors, and officers in complex securities litigations, government investigations, and commercial disputes in federal and state court. Before joining SciFROT, Matt was a litigation associate in the New York office of an international law firm. While in law school, he served as submissions editor of the Harvard Negotiation Law Review and was a semifinalist in Harvard's Ames Moot Court competition. He interned for the United States Attorney's Office for the District of Vermont and for the Attorney General's Office for the Commonwealth of Massachusetts. Prior to law school, Matt earned his BA in History and Political Science at the University of Pennsylvania, where he graduated summa cum laude, and he joined us a few years back and has been doing outstanding work with us since. Now let me turn things over to Daphne.
Thank you, Greg, and thank you for that kind introduction. I know for most of you, Greg Markell needs no introduction, but I'm proud to introduce him briefly anyway. Greg is chairman of the litigation department of SciFROT Shaw's New York office. He's co-chair of the national securities litigation practice at the firm and is a member of the national litigation leadership team. Greg is a nationally known trial lawyer with vast experience in securities litigation, directors and officers defense, mergers and acquisition litigation, corporate governance litigation, and antitrust litigation, particularly in bet your company cases. Greg is recognized as a leader in the profession who has for years been highly ranked by Chambers for securities litigation. He was named by Best Lawyers as M&A Litigation Lawyer of the Year for 2018, as well as currently a leading lawyer in securities, antitrust, and commercial litigation. Law Dragon magazine recently inducted Greg into its Hall of Fame and recognized Greg as a legend and one of only 50 lawyers and judges in the legal profession in the United States who was named to the Law Dragon 500 for 10 consecutive years. He's also been recognized by many other publications, including by Benchmark as a National Litigation Star for outstanding performance, by Best Lawyers in America, Legal 500 Leading Commercial Litigators, Best in Class in the Legal Profession by bestofus.com, Marquis Who's Who for a Lifetime Achievement Award, Super Lawyers, the International Who's Who of Commercial Litigators, and many others. Greg has repeatedly been a winner of the prestigious Burton Award for Distinguished Legal Writing. He is the chairman of the Center for Corporate Governance at New York County Lawyers Association. And prior to joining Cyfarth, Greg was chair of the litigation department and chair of the securities litigation group for 12 years at Cadwalader. Greg is a graduate of Yale Law School, the University of Michigan, with an MBA in finance, and Columbia College. Greg also serves as a mentor to Matt and I, and we're very proud to be presenting today with him. I'm now going to provide
Daphne. Oh, sorry. I thought you were finished. Sorry.
I am finished with your introduction.
Oh.
I'm now going to provide a brief overview of today's presentation. So in part one of this series, we walked through some statistics on special purpose acquisition companies, or SPACs, the basic on the structure of a SPAC, and discussed some of the resulting litigation and regulatory risks and suggestions for minimizing those risks. And for anyone who missed part one and is interested, there's a recording available on the firm's website. But today we're going to provide an update on those statistics and then a short refresher on the structure and history of SPACs for those who may not have seen part one. And then we're going to look into some important Delaware Chancery Court decisions related to SPACs and turn to the SEC proposed rules and the reactions to those rules and the impact on the SPAC market, which not surprisingly has been quite significant. So if we turn to the first slide now, let's start with the statistics and what they mean. And on the first slide, you can see the numbers. For those of you who joined the first part of the webinar, there's going to be some repetition, but the data has been updated. As you all likely know, 2020 and 2021 saw a large surge in the number of SPAC IPOs. 2020 was coined the year of the SPAC, with 248 SPAC IPOs in 2020 as compared to only 59 in 2019. According to SPAC Insider, in 2021, there were 613 completed SPAC IPOs and an additional 109 SPACs that filed for IPOs but have yet to complete the IPO. And to put those numbers in context, and if we turn to the next slide for just a minute, you can see that of the approximately 1,000 total IPOs in 2021, 613 were SPAC IPOs. That means that about 60% of the IPOs in 2021 were SPAC IPOs. Now, if we go back to the first slide again, we can see that of the 613 completed SPAC IPOs in 2021, only 66 companies have finalized the de-SPAC transaction as of this date, with another 87 SPAC companies that have announced merger deals but have yet to complete them. That means of the SPACs that completed their IPOs in 2021, there are 460 SPACs still searching for merger partners or targets. There are also an additional 62 SPACs that went public in 2020 that are still searching for targets and nearing the end of the typical 2-year window to complete a de-SPAC transaction. And while the SPAC market has clearly slowed in 2022, and for the reasons we'll discuss later, we think that slowdown is going to continue. Thus far in 2022, there have been 69 SPAC IPOs, and only one of those SPACs has announced a merger partner. So that means the number of SPACs currently seeking merger partners is a staggering 590. I should note for a second, this number is slightly lower than the 608 we reported in April, because a handful of SPACs have completed or announced mergers since that time. There have been a few more liquidations since April, and there has also been 11 new SPAC IPOs that have been announced since April. And as we discussed in detail in the first part of this webinar, this 590 number means there's an increased competition for profitable targets, and that could result in lower quality deals and operating companies with poor performance, which undoubtedly will lead to litigation. And in fact, we're already seeing a recent increase in the number of going concern warnings issued in connection with SPACs. There has been a report that recent going concern warnings related to SPACs is at about double the rate of those issued in connection with companies that went public through traditional IPOs. The going concern warnings are likely an indication that the acquired companies lack sufficient revenue and can't meet projections. I'd now like to turn.
Can I just interrupt for 1 second, Daphne? I'm sorry.
Of course, please.
Yeah. If you've already said this, I apologize, but just in case there are those in the audience who don't know the origin of going concern warnings, most of the major accounting firms, pursuant to accounting rules, if they conclude when they're doing audits of an accounting of a company that there is danger, significant danger that the company may not survive financially, and that's what Daphne so ably said, the accounting firm usually asks the company to disclose that they have gotten a going concern opinion. So the fact of those going concern announcements not only indicates that the company likely has some concern, but their accounting firm does also. Thanks. That's all. I just thought to add that.
Thank you for that clarification, Greg. That's exactly right. Now, if we can skip forward 2 slides, I'm going to give a brief refresher on the basic SPAC structure. So special purpose acquisition companies began to emerge in the 1990s after the SEC issued Rule 419 to regulate certain other blank check companies, for example, those offering penny stocks. And while SPACs have been around since the 90s, they began to increase in popularity in 2019 and were going strong by the second half of 2020 and early 2021. And as we discussed last time, they generated even celebrity interest. SPACs were viewed by many as a cost-effective and streamlined way for a private operating company to become public while avoiding the often time-consuming regulatory hurdles involved in a traditional IPO. And I want to stop for a second and note that the premise the SPAC process is more cost-effective to shareholders has been challenged. And as Greg will discuss later, the SEC recently proposed rules that would bring SPAC IPOs in line with traditional IPOs from a regulatory perspective, and certainly make them less streamlined. A SPAC has no commercial operations at its formation. It raises money through an IPO by a shell company with the intention of using the funds from that IPO and then sometimes additional funding sources, for example, PIPE funds or private investment in public equity, to acquire a company with ongoing business operations to be identified sometime after that IPO. The target company then typically merges into the SPAC in a transaction that is referred to as the Spac Transaction, resulting in an operating company with publicly traded shares. So because the SPAC is not an operating company at the time of the IPO, the SPAC IPO process as it currently stands, without SEC rules, involves more, or the new SEC rules, involves more limited disclosures than a traditional IPO, usually with focus primarily on the experience and expertise of SPAC management and sponsors rather than detailed financial reports or business history. And because the SPAC typically doesn't have a specific target company in mind at the time of the IPO doesn't involve detailed disclosures regarding targets, their business operations, financials, or projections. Again, as we'll discuss later, some of the features that have led to the so-called SPAC boom, including these more streamlined IPO disclosures, will likely not survive formal SEC regulation that we expect will be adopted. Once the SPAC IPO is completed, the IPO funds are placed in a trust account until the merger or de-SPAC transaction closes. The SPAC then must identify a target and consummate the transaction within a relatively tight time frame, which is typically 2 years from the time of the IPO, though the deadline can usually be extended by shareholder vote. And when a target is identified, ultimately the proposed transaction is then put to a shareholder vote. Shareholders will have the option to redeem their shares for cash, and they can do so prior to the de-SPAC transaction if they're not satisfied with the selection of the acquisition target or the terms of the deal, or really for any other reason. Another aspect of the SPAC structure is that the initial investors are often offered both shares of common stock as well as warrants. The warrants allow the shareholder the right to purchase from the company a certain number of additional shares of common stock in the future at a set price, which is often a premium to the stock price at the time of the warrant is issued. In a typical SPAC transaction, shareholders who redeem their shares for cash prior to the de-SPAC transaction get to retain those warrants, sometimes resulting in some dilution of value to the remaining shareholders. If the transaction is not finalized within the designated time period, the SPAC will be liquidated and the trust funds are returned to the shareholders on a pro rata basis. The SPAC sponsor typically receives a 20% interest in the SPAC, and that converts to shares of the public company at or after the merger. And so significantly, in the event that a transaction is not consummated within the designated time frame, the sponsor's interest is typically forfeited or becomes valueless. And it's this aspect that shareholders and regulators have raised concerns about, arguing that this results in a potential misalignment or conflict of interest between SPAC sponsors and SPAC shareholders with respect to the incentives to close a deal. And this is something that the SEC seeks to address through its proposed rules, or one of the things that the SEC seeks to address. If we now turn to the next slide, we can look at SPAC litigation risks. In part one of this series, we discussed federal securities litigation risks associated with public disclosures required in the SPAC process. And as we noted last time, most of the federal SPAC security suits that have been filed thus far focused on alleged misstatements or omissions in disclosures relating to the de-SPAC transaction, with plaintiff lawyers filing suit alleging violations of Section 14 of the Securities Exchange Act of 1934 almost immediately upon the announcement of the deal. And this is because, for now, the de-SPAC transaction is the most fraught with risk from a securities litigation standpoint, because the disclosures in connection with the vote on the acquisition, unlike the IPO disclosures, include details regarding the target's business operations, financial projections, and historic operations, all of which could give rise to securities litigation risks. As we'll discuss later, the SEC's recent proposed rules contemplate strict liability treatment for disclosures in the de-SPAC transaction, even where the transaction doesn't involve the issuance of new shares. It also contemplates potential liability in connection with the de-SPAC transaction for the acquired company and the underwriter of the IPO that are not typically involved in the de-SPAC transaction disclosures. In addition to the security suits filed in connection with SPAC transactions, SPAC litigation has also been filed in courts, especially Delaware, and that's what we're going to focus on today. The Delaware Chancery suits typically involve claims of breach of fiduciary duties and unjust enrichment against directors and controlling shareholders, such as sponsors, based on allegations of misalignment of interest and purported conflicts of interest. And it's clear that the Delaware Court of Chancery is very interested in addressing these issues in the context of SPAC transactions. The SPAC-related derivative suits and breach of fiduciary duty suits filed in Delaware Chancery Court have resulted in some interesting Delaware Chancery Court decisions that Matt's going to discuss in detail now. So I'm going to turn things over to Matt now.
Well, thank you so much, Daphne. As Daphne discussed, there have been some very notable cases in Delaware and, as we'll see, even other state courts involving state tort claims relating to SPACs. Delaware courts in particular have been focused on SPAC issues, which is not surprising given Delaware's focus as a business-oriented court, and the Delaware Chancery Court in particular. And thus far, the Chancery Court has issued a couple of decisions suggesting that they are concerned about the misalignment of interests allegedly inherent in SPAC transactions, and that they believe court intervention may be necessary in the SPAC space. So I'm going to talk about a couple of recent decisions, both of which are by Vice Chancellor Will, both in the Delaware Chancery Court, and those are the multi-plan decision in January and the Lordstown decision this past March. So both very recent, really, in the last few months. The first notable Delaware case to discuss SPAC issues in particular is probably the January 3rd, 2022 denial by Vice Chancellor Will of a motion to dismiss in the multi-plan litigation. This was a somewhat messy case as it involved a SPAC which can happen faced both federal and Delaware litigation following a short seller report. And if you recall from part 1, we talked about how these short seller reports are a big risk factor in leading to follow-on litigation in the SPAC space. And in the Delaware Chancery Court piece of this SPAC litigation, the plaintiffs there allege breaches of fiduciary duty against directors and officers and the company's controlling stockholder. So Vice Chancellor Will issued a decision denying the motion to dismiss, and it was a very interesting, very lengthy, very thorough decision, 61 pages. And in that decision, Vice Chancellor Will noted that Delaware courts have not previously had an opportunity to consider the application of our law in the SPAC context, and that well-established Delaware legal principles led the court, despite the novel issues presented, end quote, to conclude that plaintiffs had pleaded viable, non-exculpated claims against the SPAC's controlling stockholders and directors. And that ruling included several significant conclusions. One, that it was a direct, not a derivative suit, despite defendants' best efforts to argue otherwise. The court held that the claims asserted were direct claims, not derivative claims, relating to the impairment of the plaintiff's redemption rights due to the alleged lack of full disclosure, not just simple overpayment claims, which defendants argued were just derivative claims. She also held that these were not quote-unquote holder claims that would not be appropriate under Delaware law for class action treatment because the shareholders were faced with the choice of voting to approve the merger or voting to redeem. They weren't just passively holding their shares and not having any active involvement. The court also very notably concluded that the entire fairness standard, not the business judgment rule, applied. And this could have very far-reaching implications because the business judgment rule, of course, is what defendants were hoping that the court would follow, but the court held that the entire fairness standard applied due to, and quote, the inherent conflicts between the SPAC's fiduciaries and the public stockholders with respect to the transaction. So the court there acknowledging that there is, at least allegedly, this potential conflict of interest. So Vice Chancellor Will also explains that the duties of care and loyalty include a duty of full and fair disclosure when fiduciaries communicate with shareholders, and that the duty of loyalty mandates that the best interest of the corporation and its shareholders take precedence over the interests possessed by the director, the officer, the controlling shareholder, when those are not shared by the stockholders generally. Notably, Vice Chancellor Will emphasized that her conclusions stemmed from the specific facts at issue in her case before her, leaving a door open for future litigants to distinguish their facts. But she also acknowledged that many of the features, and this is another quote, many of the features that I consider in this opinion are common to SPACs, although some entities have more bespoke structures intended to address conflicts, end quote. And when we get to the takeaways at the end of this presentation, we'll discuss how exactly to potentially mitigate the risk of the at least appearance of a conflict of interest in the SPAC transaction. In addition, Vice Chancellor Will appeared to suggest that the alleged misalignment of interests alone, that would not always lead to liability, and that in the case before her, as in most SPAC transactions, quote, the mismatched incentives, were known to public shareholders who chose to invest in the SPAC, end quote. And that's an important key point for the defense there, and defense of similar litigations that'll come up. The mismatched incentives, however, is what Vice Chancellor Will ultimately looked at in determining to apply the entire fairness standard over the much more deferential business judgment rule review. Vice Chancellor Will specifically noted that her conclusion does not address the validity of a hypothetical claim where the disclosure is adequate and the allegations rest solely on the premise that fiduciaries were interested given the SPAC structure. But she didn't seem to reject such a notion either. And at the record date, just to go into the facts a little bit more specifically, at the record date, the founders' shares were worth an amount representing a substantial gain on the sponsor's initial investment. That value would have dropped to zero had a deal not been consummated, of course, and the SPAC just liquidated. The public shareholders, they would have received $10.04 a share if the SPAC liquidated rather than consummating a transaction. Instead, they alleged that they redeemed, that what they received were shares worth significantly less than $10.04 a share, and thus the plaintiffs alleged the merger, it was more valuable to the sponsor at a price below $10.04 a share because the sponsor would have gotten nothing if it had liquidated. But it was only valuable to the shareholders as compared to a liquidation at a price above the $10.04 a share that it would have liquidated at, and thus the plaintiffs were able to craft their argument that the sponsor gained a unique benefit from that merger. Defendants argued that, well, the fact is, nearly 60% of the sponsor's shares would unvest on the closing of the merger and only revest if at some time 1 year after the merger, but before 5 years, the shares exceeded $12.50 for trading days in a 60 consecutive day period. So saying, you know, we really didn't have this conflict that plaintiffs are alleging we had. But the Vice Chancellor Will, concluded that for purposes of the motion to dismiss, she would not determine that this quote unquote unvestment would negate the sponsor's alleged windfall. She also held that the 19 months left to the merger window did not negate the potential misalignment of interest. So she somewhat rejected defendants' arguments here, though looking specifically to the facts of the case. It should be noted the multi-plan complaint made some particularly extreme allegations, including that while the proxy disclosed that multi-plan was dependent on a single customer for 35% of its revenues, it allegedly did not disclose that this same customer was creating a platform that was going to compete with multi-plan, which is a fairly extreme allegation. In addition, there's allegations that the proxy didn't include a third-party valuation, a fairness opinion. The financial analysis of multi-plan relied on in the proxy was allegedly prepared by Churchill Management with assistance only from the group that was controlled by the SPAC sponsor itself. So there's room in future litigations, of course, to distinguish the facts. The case was ruled on by the facts that were alleged in the complaint, so it's not the last word. But that said, it is a very interesting case that shows the tremendous interest. It shows the Delaware Chancery Court's willingness to say that there's an alleged misalignment of interest here, and therefore we're not going to apply the business judgment rule. We're going to apply this entire fairness standard. So it's a very interesting case. And also interesting, just a few months later, March 7th, 2022, Vice Chancellor Will, same judge, released another very notable Delaware decision declining to stay a Delaware suit while a federal securities class action stemming from the same transaction was resolved. And this was the Lordstown Motors Corp decision. The Lordstown case is particularly interesting because defendants moved to stay this putative class action pending the resolution of the federal securities class action relating to the same de-SPACing transaction. And you can see the logic of defendants' arguments. They're facing expensive parallel litigation in state and federal court arising from effectively the same facts, and they're just different causes of action. So why not stay the state case, let the federal case resolve? But the Chancery Court didn't see it that way. It declined to stay the action, noting, among other things, that the case raises emerging issues of Delaware law, and that the court had occasion to apply the doctrines of fiduciary duty law in the context of SPACs and stockholder redemption rights, and only one other previous decision, of course, a reference to her multi-plan decision a few months earlier that we just discussed in detail. So the Lordstown decision in particular, it's really a boon to plaintiffs and plaintiffs' attorneys because it indicates that companies might face suit in federal court and separately Delaware court in connection with the same Spac transaction, increasing the expense of litigation, increasing the pressure to settle, and just really making it much more difficult to defend litigations in this kind of multi-pronged attacks from different plaintiffs' attorneys are asserting ostensibly different causes of action. So looking at both Multiplan and Lordstown, we see two decisions that indicate that the Delaware Chancery Court, and in both cases, Vice Chancellor Will in particular, though we can perhaps extrapolate to the Delaware Chancery Court in general, are very interested in SPAC issues, very interested and focused on protecting shareholders from allegedly unfair sponsors, allegedly unfair SPAC transactions, this alleged conflict of interest that we discussed in great detail in part one of where, there's this easy to argue alleged conflict of interest between the SPAC sponsors and the shareholders, given that SPAC sponsors, of course, have an incentive to close a de-SPACing transaction as opposed to redeeming their shares. Now, separately from all this, and perhaps more mundanely, but following Multiplan, Delaware courts have also had occasion to address issues arising in SPAC-related transactions, applying just ordinary principles of Delaware law that aren't unique to the SPAC world. So I'll just give one example, a February 28th, 2022 decision called Blue versus Fireman, and that's from Vice Chancellor Zern. And in this case, the largest creditor of the target company in the de-SPAC transaction allegedly demanded favorable amendments to debt and warrant agreements and allegedly threatened to block the pending merger. So then 2 days later, the board approved the creditor's demanded amendments, announced the merger, and plaintiffs' investors brought a breach of fiduciary claim, alleging that the merger was unfair due to diversion of the merger proceeds from the stockholders to the creditor, and defendants, of course, moved to dismiss. The court saw this just as it would have seen any other transaction. Its decision was not very unique to the SPAC context. It applied general Delaware law principles. It rejected defendants' arguments that the stockholders' claims were derivative, and it found that because the creditor was the target's controller by virtue of its voting power, as alleged in the complaint, it owed the target stockholders a duty of loyalty. This is interesting, not necessarily because it's a SPAC, but it's interesting because it's an example of a Delaware court applying the principles of Delaware law to a SPAC transaction as if it were any other transaction. And Delaware, of course, has a vast, vast body of corporate and business law and mergers and acquisitions law, and we're seeing more and more cases where the law that's applied is applied to a SPAC transaction. And finally, as I referenced briefly earlier, Delaware, it's not the only forum which is so far seeing litigation arising from SPACs. Reuters' investigation from last May identified over 60 lawsuits filed in New York State Court against SPAC boards of directors, alleging breaches of fiduciary duty by omitting information from public filings about the proposed acquisitions. Now, notably, these cases have not seen any judicial intervention or activity, but rather are being resolved with supplemental disclosures and payment of mootness fees to plaintiffs' lawyers. This is something that's been seen in mergers and acquisitions law for time immemorial, it seems, but it's effectively what could be called a quote-unquote deal tax, as seen in other M&A contexts, because it's usually easier for a company to come to a quick settlement rather than to enter into full-blown litigation over whether or not it had omitted information from public filings. And this is an issue which Seyfarth has written extensively about, including the three of us presenting on this call. So for more information on this deal tax and the history of it, we had a February 2022 article in the D&O Diary. Greg and Daphne and others. Seyfarth had a March 2021 article in Law 360. And as to why these particular SPAC litigations were brought in New York rather than Delaware, when the instinct is normally to bring such a case in Delaware. Well, it's an interesting history, but Delaware law is more hostile to these disclosure-only settlements ever since 2016, when the Chancery Court issued a decision called Trulia, which Greg has written extensively about. And it appears likely that plaintiffs' firms have moved on to New York and perhaps other forums as more hospitable for this kind of litigation. So before I turn the presentation over to Greg, I would like to announce the CLE code. So write this down. It is SS as in Seyfarth Shaw 2736. So S as in sugar, SS 2736. So I'm now going to turn the presentation over to Greg Markell, who's going to discuss the SEC's proposed rules and how they are impacting the SPAC market. Greg?
Thank you, Matt. That was a very good job. I have to say, before I move on to the SEC, I have one or two comments, particularly about multi-plan, that are my own, speaking from my own personal point of view. And I guess the first thing that I would note is, as Matt did, but I want to emphasize, this is a motion to dismiss. So the allegations of the complaint are assumed to be true. So in terms of evaluating what the Vice Chancellor was doing in that case, she made it very clear that she was not finding facts, that she was looking at the allegations of the complaint. If those allegations are true, and they may or may not be, as with all complaints, I find some of them pretty egregious and problematical from the standpoint of a corporate governance person. One of the areas I dabble in is corporate governance. According to the opinion, and again, we're talking about allegations from the plaintiffs, so they may not be true. All of the directors were appointed by and could be knocked off the board by one person, a guy by the name of Michael Klein, who had done several of these deals before. And each of those directors, again, according to the complaint, stood to make in the low millions of dollars from the deal that was proposed, if it went through as planned, right? But again, that may not be true. It seems to me that this is an unusually not independent board of directors, and if the allegations are true, and I'm going to stop saying that, but this is part of everything I say about multi-plan. Michael Klein had done several of these deals, controlled who was going to be on the board and could knock people off the board, and is of a firm that he owned or controlled, did the financial advisory work relating to the value of the relevant company, which was Churchill. So, to me, this is a true controller, and under Delaware law, if the controller is likely to benefit in a way different from shareholders, and you can debate that issue, that calls for the application of the entire fairness standard. And according to the opinion, it's alleged that he was going to make $356 million if that deal went through as planned. So I think it's hard to argue with the conclusion of the Vice Chancellor, if the facts are correct, that there was in fact a a situation where the best practices of corporate governance were not followed, and that there were conflicting interests. And again, I will repeat myself again. If the facts were true, I think she would come, if she came to the same opinion on the merits as she did on the motion to dismiss, she would be finding correctly that that there should have been some disclosures in these areas that didn't appear. But I think, in my opinion, the facts alleged are laying out a potentially egregious case, and so I'm not sure how representative it is of many other SPAC cases which would have less egregious facts. Now, having interloped in that, but I couldn't restrain myself because I do find Multiplan an extremely interesting case, so I did want to put in a few comments on it. Let's move on now to the SEC, which is also pretty interesting, but probably, in my view, somewhat more problematical than what Vice Chancellor Will was saying. And so what I would first like to point out is that this morning, Law 360 came out with an article that says that, which actually described some of the criticism of the SEC's proposals. And I will get into some detail on the proposals in just a couple of moments, but a large number of comments have been received, according to the article, and 78 or so. The majority of them, it looks like from the article, are critical of the overreaching by the SEC or the over-regulation by the SEC. The SPAC activity, according to the article, has plunged in recent months. Clearly, the statistics show it has declined significantly. I don't know if I'd use the word plunge necessarily, but okay. And then you have some industry groups that are looking for industry reform. There are industry groups that are criticizing the rules. There are other industry groups that are trying to see reform in the securities industry who are pro the proposal. This is, as I say, this came out this morning. The comment period ended a week ago. We don't know how long it will take for the SEC to decide what they are going to do. And I guess what I would say is my own view on this is, we're probably be somewhere in the middle. I do think some reform on some aspects of SPACs and some additional disclosures made sense. I think the SEC has gone overboard. That's my personal opinion, and not anybody else's that I know of. And I think there are arguments, and we'll get to those in more detail shortly, that they may not have had authority to put in place some of the proposals that they are making. That is, the SEC didn't have authority or doesn't have authority to effectuate those couple of the new rules, at least in their current form. All right, so what happened? Back in March, the SEC came forward, led by Gary Gensler, who came into office about a year ago, promising that he was going to strengthen disclosures and strengthen regulation in a variety of places, including in the securities markets. He made speeches to that effect after Biden was elected, after he was appointed, after he was approved, and continued to preach that was what the FCC would be doing under his leadership as chair of the FCC's of the chair of the commission. he is, and so what is it that he has done? Well, I'm going to run through what I consider to be some of the key provisions, and then I'm going to go, if we still have time, to what I think some of the effects of those provisions are. But many of you will be able to imagine what some of the effects are of these, of what I am going to recite as the key provisions. To be clear, there are no rules. None of these new proposed rules are in effect now, and they will not be in effect until the commission finally approves it. And I predict there will be some lawsuits that will question the SEC's authority to do some of the things they're purporting to do. As kind of an overall basis of what they're trying to do with these rules, the SEC has made it clear that they think there is no reason why the rules relating to traditional IPOs shouldn't apply in most cases to SPACs. And so what they say they are doing overall with this set of rules is they're trying to conform SPAC regulation to regulation of traditional IPOs. Traditional IPOs, and this goes back many, many years. After all, we're dealing with the 33 and 34 Acts and a lot of securities law as amended by the PSLRA in 1995. The rules were designed originally to try and make sure that there were full disclosures to potential buyers of securities in the markets. That would be true of many different provisions of the 33 and 34 Act, but in particular, it would apply to initial public offerings of securities, and those rules are quite strict in terms of the disclosures that must be made, and there are significant penalties if there are either misrepresentations or material omissions in those in the disclosures made by filing companies for traditional IPOs. And so that is the purpose of the original acts with respect to the traditional IPOs. The result of the proposed rules, which are incidentally with respect to SPACs, over 350 pages of material. And I have not read every single page, let me tell you. But I've read a lot about this issue because I think it's dramatically important in the capital markets today. Let me now start going through some of the specific rules. Under the PSLRA, for many kinds of alleged violations of the 33 or 34 Act, there's a safe harbor. The Private Securities Litigation Reform Act is PSLRA. There's a safe harbor for forward-looking statements under certain circumstances. Largely, the circumstances are that the statement is forward-looking. It's not a statement of past fact, and number two, that the person making the statement, either in writing or orally, believes it to be true and has no reason to doubt that. And as long as it's a forward-looking statement, that there is a safe harbor, there is no liability, even if it turns out that the forward-looking statement was incorrect. in the proposed rules, the SPACs would not have that same kind of safe harbor under the proposal. And I'm going to stop saying under the proposal after every sentence, but these are all what I'm going to be talking about are proposed rules, not actual rules yet. So you have that's a disadvantage. Why is that a disadvantage? It's obvious. It's obvious because it does mean that some forward-looking statements could be sued upon, which could not have been sued upon in certain kinds of securities cases, although it did not apply. This safe harbor did not apply to IPOs. It's under Section 11. Under Section 11 of the Securities Act is a very strict liability act. That creates that, but it's a negative from the point of view of all the participants in a SPAC transaction, including the underwriters, that safe harbor doesn't apply. If it doesn't. The next thing to raise, and this is one of the important ones in terms of longer term effect, is co-registration liability. So the targets here are typically operating companies unrelated to the SPAC. The SPAC is looking for an operating company to acquire, and under a lot of circumstances, and it would take pages of material to get through all the detail. The new proposal says that the SPAC and the target company would be treated as co-registrants in any filing relating to the de-SPAC transaction. Well, what that means is that not only would the SPAC have potential liability if there's a misrepresentation or omission, but under Section 11, which is a very strict rule of liability, if there's a misrepresentation or omission, not only would the SPAC be potentially liable, so would the target, and the target may or may not have control of the documents that are being filed at that point in time relating to the acquisition. What that does is it's a disincentive for companies, if approved, to want to be targets because of the potential Section 11 liability. I see we are running. We're moving quite along through our hour, so I'm going to move a little bit more quickly through some of these other provisions. But that's a serious problem in terms of the large number of SPACs that are out there and who are looking for targets. This makes it less attractive for targets to want to do these deals. Another provision that has a similar effect plus other effects is that the commission wants to extend to the underwriter of the original SPAC IPO that they're subject to regulation as an IPO, but they want it to be such that the underwriter itself can be liable for misstatements and omissions. And then it says, if the underwriter of the original SPAC deal does anything, and I'm being I'm not going to get into extreme detail on what the anything is, but if they do anything to facilitate the deal with the target company, the de-SPAC transaction, they will be treated as even though they were not retained by the target, they would be treated as an underwriter of both deals, and therefore the underwriter would face potential liability if there's some defect in the disclosures for as underwriter for both companies. Well, this is one where we've already seen adverse effects from this provision. There are already underwriters, Goldman Sachs being one, that have indicated they're going to draw back from being involved in Spac transactions going forward. And they didn't attribute it specifically to this provision, but it's clear that given the timing that this could easily have been one of the significant factors, the co-registrant liability, the underwriter liability. They may have said, let's wait and see whether these proposals are adopted. If they are, it may not be worth it from our standpoint as an underwriter to do these deals. Well, that not only it affects the underwriter, that also affects both the SPAC and the de-SPAC, because in order to complete the deal, that is the purpose of this SPAC de-SPAC transaction, you have to do an acquisition. Well, if you have a Goldman Sachs as your underwriter, for example, there are many other great firms as well, that is a big benefit in getting a deal done. It helps sell the product. It gives confidence to both the SPAC people and the de-SPAC people, or the target people, that this is a high quality deal. And if people like Goldman Sachs are scared away by this underwriter liability provision, that's another factor why it is difficult to complete these deals. Another provision which before I leave underwriters, I'm sorry. That is a provision that it's not at all clear to me that the SEC has authority to put that provision into effect. And I think there may well be litigation as to whether or not that this agency, the SEC, has overstepped its bounds by purporting to put it in place. Next, and it looks like it may be the last one I get to, but I think it's an important one in the context of what we've been talking about, are the disclosure of potential conflicts of interest. The proposed rules require that the sponsor describe any potential conflicts of interest they have, not just actual conflicts of interest, but potential conflicts of interest and it goes on to, and in a related provision on fairness, it requires the SPAC board to say whether or not they think the deal is fair to the de-SPAC company, and what their basis is for reaching whatever conclusion they reach on that. These are pretty outlandish disclosure requirements. I am going to stop here. There are additional provisions, but it runs the same way. The SEC, I think it's fine that the SEC is trying to make clearer some of the disclosure requirements of in connection with SPAC deals. I think they have gone overboard. I think they have gone too far. And I think in one or two cases, they've gone beyond their authority. Let me turn this back to Daphne. And I know she only has a minute or two left, but I'm sorry about that, but I got carried away.
No, thank you, Greg. This is fascinating. And I know we could discuss this in a lot more detail. And if anybody would like to discuss it with us, they should feel free to reach out. I know Greg has more to say. I'll be really quick. I think one takeaway from what Greg is saying and from this presentation is that we don't think the SPAC boom, to the extent that even is still here, and it's certainly dwindled, is going to survive the SEC regulations that we think are going to be adopted. But I will quickly, now that we've talked about risks, talk about some takeaways for limiting those risks. So obviously, at the time of the IPO, everything should be reviewed very carefully. At the time of the merger, the sponsor should really perform careful due diligence into the company to be acquired, the sponsor and the target, and document all that due diligence so that the process can be defended in the event of later litigation. In connection with the proposed de-SPAC M&A transaction, companies and their boards should really consider the engagement of an independent financial advisor that's paid in a way not contingent on the outcome of the deal. And that'll be useful later if the deal is reviewed under the entire fairness standard. Companies should also consider the appointment of an independent special committee to adopt criteria for a de-SPAC candidate and evaluate the potential de-SPAC transaction, and that'll help with later claims of conflict of interest with respect to the transaction. I'll very quickly, with respect to forward-looking statements, which are for the moment still protected, but which under the new rules, if adopted by the SEC, will not be, all projections should be reviewed carefully. They should include clearly identified language stating that they're forward-looking and meaningful cautionary language that should never be boilerplate and should be specific and change over time. The company should clearly document the analysis that led to the projections and the assumptions and bases for those assumptions, also because when projections are missed, there's going to be litigation, and it'll be helpful to document those assumptions for later litigation. Deal lawyers should always consult and work with litigators to help ensure that disclosures are defensible. If the proposed SEC rules are adopted, which we expect, the target company will also have to carefully review merger-related disclosures issued by the SPAC. And then I should note that we've seen companies adjusting the SPAC structure to try to insulate from some of the litigation risks and diminish the misalignment of interest by more closely tying sponsor fees to the merged company successes. But as Matt noted in connection with the multi-plan litigation, these adjustments have not always insulated companies from litigation. So with that, I'll end. I'll remind everybody the CLE code is S as in Seyfarth, S as in Shaw, 2736. And thank you, everybody, for joining us today. If you'd like to discuss further, please reach out to any one of the three of us.
Okay, and let me just put in one or two very, very quick comments. I agree with everything Daphne just said. She did a terrific job. I also do want to say that the fact that I didn't agree in every respect with Matt should not reflect on what I thought was an excellent job that he did. Reasonable people can disagree a little bit on minor points. We happen to come out a slightly different place, but he's did an outstanding job, and I don't want anybody to think that I think otherwise. Thank you all, and Daphne did as well. And thank you all, and I hope you all have a great day and that this was useful to you.